following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host, David Blain. We thank you for joining us today. We've got a great show lined up for you here on 94.1 FM WNBU, as well as cable TV 10 in New Bern, North Carolina. We got Bob Register helping engineer the show there. We appreciate all his efforts for us. We also like to hear from you, our viewers and listeners. Give us some great ideas for the show, some good comments as I see people around town, people email in, people call. It's just nice to get some feedback, listening to what people are thinking about, what they want to hear us discuss. In fact, today's show is going to be the direct result of that. We're going to talk a lot about what's going on in the markets, especially with regard to quantitative easing and the implications for a long-term investor. Before we do, let's give out that phone number if you do want to get in touch with us. Our number here is 252-633-0107. The email to the show is allthingsmoney@dlblain.com. And of course, you can visit us on the web, which is the best way, I think, to contact us. There's a lot of information out there. It's dlblain.com. That's dlblain.com. We got all the archive copies of the show. You can watch it right there on the computer streaming. You can download it to your iPod or MP3 player, take it with you. It's just a great resource. We also have printed articles there for those you like to read articles. It's just a great resource for investing. Okay, so into the show we go here today. We want to talk a lot about what's been happening in the markets. There's a lot of concern with back in May. People opened their statements at the end of May or June, and they were a little bit shocked as to what was going on in the marketplace. They weren't prepared for it. Well, the chairman of the Federal Reserve, Ben Bernanke, had come out and made some comments about possibly discontinuing what's called quantitative easing. It's a program where the Federal Reserve has been buying about $85 billion of bonds per month and putting them on their balance sheet. So the Federal Reserve is actually a group of banks headed by Bernanke, and what was happening is that they would go out, the Treasury or the Mint would actually print money, and the Treasury would issue it to the Federal Reserve, and then they would go out and they would buy these bonds to hold them. So it's sort of a circular thing where the Treasury, prints the money, gives it to the Fed, and the Fed goes and buys these bonds. So it's an indirect way of, sort of giving money to yourself. It's sort of really strange if you start really looking into it, but maybe they will do that for another show. The point of the matter is that this has been going on for some time, and Bernanke said that he was going to they were going to start scaling back this bond buying, and so this caused markets, emerging markets, U.S. markets, bond markets, commodity markets, everything sort of fell. And why is that? Is because interest rate, whenever you're evaluating whether it be any type of investment, the key determinant is the interest rate, which is also another key determinant is inflation. But that interest rate is what's called the discount rate. Without going into too much technical information, the discount rate is what determines the ultimate rate of return on an investment. It's that sort of hurdle rate. And as the discount rate rises, the value of longer-term investments will fall. And so what we saw was that immediately upon this announcement, we saw people revising their discount rates. They may not have done it, on a spreadsheet like we do or implicitly, but sort of everyone just sort of started reappraising risk and discount rates and things like that. And so people immediately reacted to this new information and started repricing securities. So that's the first thing, is that the markets are efficient. You can see almost an instantaneous repricing. We've talked about this many times on the show, is that, you know, whether it be hedge funds or short-term traders, that the market reacts very quickly to new information. And that's exactly what happened. Bernanke came out. This was new information. People weren't really expecting it, and the market reacted very quickly to it. The second thing that I wanted to mention, that for long-term investors, what I want to do, let me back up, is I want to give some implications for long-term investors. Now, if you're a short-term trader, this is not for you. In fact, the show is not for you. You know, spin the dial over to the right or left. But we're talking about for long-term investors. These are a few ways of looking at it. So first takeaway you should take is that markets are pretty darn efficient, and they reacted very swiftly to Bernanke mentioning that he might be ending the bond buying, or tapering the bond buying program. The second is that policymakers are considering a change, and it's not a prediction about the direction of the economy or anything. What you should take from this is that policymakers are contemplating a change in policy. That's it. Third, for all the people that are, you know, dumping bonds or dumping risky assets because Bernanke mentioned that they might taper the program, you got to remember that someone else bought that asset. And this notion, I hear this all the time, that this notion that there are more sellers than buyers is just completely false. This is not, what was that game you used to play as a kid and people would walk around the chairs and pull a chair out? That is not that. If you have, there's a finite supply of stocks and bonds, and everyone at any given time owns them. So they can't just be left out in limbo. Now, if there are fewer buyers than sellers, yes, the price goes down. I mean, it's supply and demand, and so it drives the price down. But someone bought it. There is a price at which someone bought it. And so you have to remember that someone thinks that is a good value, that a corporate bond now paying, 4%, it was paying, 3% a couple months ago and is now paying 4%, so the price went down but the yield went up. There are people out there that think that's a good bargain, and they're buying them. So don't forget that. For every seller, there's somebody that's buying it. At the depths of, 2008, people selling Ford Motor Company, there were people buying it. Now, the same token, there were people selling Lehman, and there were people buying Lehman Brothers, which of course went bankrupt. But the point is that there's always, someone has to own the security, so someone thinks that they're a good deal. When you're dealing with whole asset classes as opposed to individual securities, you really have to question, is the whole asset class, trillions of dollars, essentially worthless? Well, no. I mean, there are people buying them. All right, so the next point that I want to make is that the rise in interest rates indicates that the market in aggregate thinks rates are going to rise in the future. That's already priced in. So you sitting there at home saying, well, I think the rates are going to rise in the future, that's already priced in. I mean, the markets instantaneously adjust to that new information that bond yields are going to rise. And so what's going to happen next, we don't know. But what we do know is that first incremental rise in interest rates, it's already priced in. So if you think interest rates are going to rise soon, that's already priced into the market. You can look at the futures market to see, I don't have it in front of me and I don't have a computer with me here, but if you look at the futures for interest rate futures, you can see what the market expectation is for the future. And I want to spend, we're coming up to our first break, but I want to spend a little bit of time on, I said what happens next we don't know, and I'm going to talk a little bit about some experts that were predicting back in November of 2010 of a runaway inflation and debasement of the currency and how they were completely wrong. So for All Things Money, I'm your host, David Blain. We'll be right back after a few short messages.